Welcome back to The Big Perspective, where we talk to some of the smartest minds in the Indian markets and pick their brains about the biggest trends shaping our stock markets. I'm your host, Bhavya Dua. A lot has been happening in the markets. Some sectors have seen crazy rallies. There have also been valuation concerns in the markets. The domestic and global economy have seen some interesting times post the COVID. To cut it short, there's been a lot of enthusiasm and excitement around us. And to make sense of it, we spoke to Ashish Gupta, Chief Investment Officer of Axis AMC. In his career spanning over 25 years, he has got his hands dirty in research at Credit Suisse, a first-class high-impact research organization, before he transitioned into a new role of using research to deploy money as a CIO at Axis Mutual Fund. He shares his views about the bull market run, mega trends that he's looking out for like China Plus One, sectors like power and defense that seem promising to him, the current state of the Indian banking system, and the road ahead for NBFCs, increasing flows in the markets with the wave of IPOs and flooding stake sales, market sentiment versus the reality, and much more. Listen into this conversation with him on his Big Perspective.
The fact that market has not given a negative return for the last 8 years does not mean that every year, even in the future, it will give positive return itself. Particularly for new investors that have come in the market over the past few years, they have not witnessed these cycles. FII underweight in India is roughly equal to $100 billion. So it's a very, very large underweight.
It's a red flag in the market right now.
You can have a simple reality check. Is earnings growth backing it or not? So my estimate is that this year will turn out to be probably for Nifty a 10-12% earnings growth year. So I think one thing that every retail investor should always seek to do is.
So Ashish, a very warm welcome on The Big Picture, which is presented by Markets by Zerodha. And thank you so much for taking out the time and being there with us and talking with us today. So to begin with, it's been a little over a year since you took this position at Axis, and you came in at a point where Axis was going through a transition period itself. So how is it going for you?
Well, I think it's been a great, remarkable journey. It's been about 15, 16 months since I joined. One thing I will, of course, say that the markets have been kind over these last year or so. But I think it's been an interesting time. We have had the opportunity of further rebuilding the organization, both overall the organization structure as well as on the investment side. We have come out with new products which have actually been ahead of time, so to speak. So, for example, we came up with a manufacturing fund. It was the first fund of its kind last year. And that theme has become very mainstream. Of course, the fund did very well over the past year. We have now also increased our focus from not just active fund, but we have a large suite of passive products as well. So yes, there's lots more to be done, but it's been an interesting journey so far.
Right. And how does it feel like to transition from research to actually using research to deploy money?
I think it's something I've done before. So before my stint at Credit Suisse, which was, as you know, about 14, 15 years, I was a portfolio manager for the global fund. So, usually I tell people that there's no other side of the table. It's like a round table. All of us are doing the same thing. We are looking at macro, we are meeting companies, and we are trying to really decipher what's going to work in the future. So I think it's very similar in that aspect.
Right. So we'll start with talking about the markets right now. So markets have been doing phenomenally well, right? So it's been 8 years of positive returns. We're in 2024, it's the 9th year, positive so far, right? So if you look at the big picture of the markets at this point, how are you feeling?
So I think at times like this, you have to really guard against complacency. I think one has to be very clear that markets are always going to be cyclical. Markets are not going to be unidimensional one way. The fact that market has not given a negative return for the last 8 years does not mean that every year even in the future it will give positive return itself. So I think we should guard against this complacency. I think particularly for new investors that have come in the market over the past few years, they have not witnessed these cycles, right? So I think they should be also cognizant of these facts, look at longer term histories. For example, when we look to hire analysts in our research team, right? One of the prerequisites I look at anyone tracking the industry that has he seen a cycle in the industry, right? So if you have only seen an upswing in the industry, or if you have seen only a downswing in the industry, then you can't really appreciate what can potentially be the future. So I think same hold true for the investors as well. And I think they should look at last 15, 20 years, what has led to market cycles, if market has corrected in the past, what it has it been valuation, has it been growth, has it been liquidity? So there are multiple factors at play.
So you touched upon valuation. So if you talk about valuation, you've also mentioned that market valuations don't have a safety net right now. So what do retail investors like us should do right now? Like how should we really brace up ourselves for this roller coaster ride that's ahead of us?
So I think one thing that every retail investor should always seek to do is have uh, investment in the market with a view that what is your time horizon, right? Yes, markets are going to be volatile. Markets may give negative returns, particularly in the short term. But if you increase the tenor of your investment, right, it is very rare that markets give a negative return. Right. So if you have been investing, particularly in India, where economic growth has been there, so if you are investing in the market for 5, 6 years, irrespective of what time you entered in the market, you would get positive return. Right. So I think therefore people should look, is the money I'm allocating in the market, do I think I will need it in 1 year? Do I think I will need it in 3 years? So if you're investing any fund in the market which you might need in 3, 6 months time, then at current multiples, my advice will be probably don't do that, right? So if you are looking at investing fund which you think that, okay, I may not need, I will be able to ride this investment for a few years, then investing today makes sense. So I think this is where that margin of safety comes into play, that for short-term funds, is it really the opportune time to invest in the market, or probably look to deploy only long-term funds into the market?
All right. So if we are considering that mutual funds can't go all cash or short the market, how do you yourselves deal with these elevated valuations that is a concern for you?
Sure. So there are 2, 3 ways to address this, right? So one is that there are products which can look at different asset classes, right? So we have hybrid fund, we have multi-asset fund, which can toggle the percentage of equity allocation. So for example, some of our hybrid funds that annually manage hybrid fund, a few months ago had equity allocation of nearly 75%. That given that the markets have moved up, we have brought down to 50, so it's about 58, 59% today, right? So we toggle in that we bring down the relative mix of equity in the hybrid funds. The other thing we look at really is what is the beta of the portfolio, what is the standard deviation of the portfolio, how aggressive the portfolio should be positioned at, right? So if we feel there is a case where valuations are becoming more challenging, we try to moderate the beta of the portfolio, right? The third is, again, like I said, that people should look at investing in the long term. We therefore look at company sectors where we are more confident of medium to long term outcomes. right? So if valuations are a concern, if multiples are high, the only way the stock will really deliver or continue to deliver if its earnings continues to grow, or and if it earnings surprises positively. So we are at this point of time very wary of companies where there's potentially a negative surprise to earnings that can come through, or if in any quarter they miss earnings, then we are very quick to kind of prune that investment.
All right, that makes sense. And like, if we go back to how phenomenally well the markets have done, what are the factors underneath this positive run of the market, according to you?
I think one of the factors clearly is that our economic growth over the last couple of years has continued to surprise positively. So I think if you see even last year economic growth at the beginning of the year, most of the estimates were less than 7% real GDP growth, and we ended up close to 8% GDP growth. So that was one factor. And this economic growth also translated to earnings growth. So if you see last 3 year earnings growth in corporate India was almost a 24% CAGR. So actually, if you look at the market returns over the 3 year period, it's largely in line with this earnings growth. If you look at mid and small cap sector, the earnings growth CAGR was even sharper. So last year, if I recollect correctly, earnings growth was in the mid cap space was almost 35% year on year, right? Yeah, we have had not just GDP growth moving up, but profitability, corporate profitability moving up. So if you go back to 2019-20, corporate profits as a percentage of GDP was just about 2.5%. Last quarter, this was up to nearly 4.5% of GDP. Right, so corporate profits are growing faster than the GDP growth, and that also supported it. The third factor, I think that's clearly aided us is liquidity and primarily domestic liquidity that has come into the market today. There is inflow of money into the market from mutual funds, and within mutual fund SIP flows are strong. There is sustained allocation of equity from pension funds, including EPFO and insurance companies. So if we kind of look at this allocation kind of demand, which is very steady demand for equity, that itself is now roughly about 35-40 billion dollars annually. Right. And last year, last 12 months, additionally, foreigners have also been buying equity. So we have this calendar year to date, we have had about $4 billion of FII purchases. So I think all these factors combined have meant that multiples have had no reason to contract and have continued to move up.
But when we talk about the fundamentals, when we talk about the earnings of the companies, and when we are expecting the good times to continue, there are still some negatives which are popping up, right? Like for all the companies that have released their earnings till now, there's been hardly any growth in terms of profitability, and even the margins, they have been shrinking. So since a mutual fund is betting on decades, I have like two this is a two-part question that I have for you here. One, should we brace ourselves up for a lower than expected returns?
So I think, as we say in all mutual fund ads, don't let past returns be an indicator of future returns. So, and if I peg returns really in line with earnings growth, so clearly, next couple of years, earnings growth is going to be a lot slower than last 3 years. This year, the forecast earnings growth for Nifty about a month ago, the consensus estimate was about 14%. But we are about 2 weeks into this earnings season. June quarter earnings are coming out. As of yesterday, about 30 of the 50 Nifty companies have reported earnings. About 100 of the NSE 500 companies have reported earnings. But clearly, as you mentioned, there's a big moderation in earnings growth. For Nifty, the 30 companies that have reported earnings, the first quarter earnings are up only about 1% year on year compared to last year. And on back of that, there have been earnings cut of nearly 2% by consensus. So my estimate is that this year will turn out to be probably for Nifty a 10-12% earnings growth year. For the broader market, the mid and small cap space, there are companies which are growing faster. But again, it's unlikely they will grow at 35% that they grew last year. Probably they'll grow at about 18-20%. So this year, you will definitely see a slowdown, large cap earnings growth at 10-12%, mid small cap earnings growth more like 18-20%. And that's should be where your returns also gravitate towards that. So I don't think just because last year market was up 28%, this year we should have similar expectations.
Right, right. So, as in, we should be ready and brace ourselves up for lesser returns, at least this year or going forward as well. And in between all of those things, are there any positive triggers for the market in your view?
So I think one positive trigger that can still play out is that foreign investors are still quite underweight India. So over the past 4 years, they have not invested in the market. It's primarily been because US rates went from 0% to 5%. Their investments in India did not keep pace with the way India's market cap was rising. Right, and so compared to the benchmark weight India has now, so on a global indices, India has almost a 4% benchmark weight, while FII's allocation to India is only about 1.5%. So they are carrying a large underweight on India. And if US yields collapse fairly quickly, then there's a potential of this money moving back quickly into the market. And we estimate the total FII underweight in India is roughly equal to $100 billion. So it's a very, very large underweight. Uh, it's unlikely it will be covered up in a quick while because US growth also has continued to surprise on the upside. The consensus is that US rates will stay higher for longer. But yes, they are moderating from their peaks because inflation rate, as you would have seen last week in the US, is down to about 2.5%.
Since we've touched upon a bit about the global economy, the globalization, the US a bit, a lot of fund managers also have this approach where they bet on mega trends, whether it's China plus one, whether it's green transition, premiumization. So, are you also someone who looks at these mega trends while making these bets? And if yes, then what are the mega trends you're looking at this point in time?
So I think certainly all of these are trends that are playing out. I think premiumization is a trend that has slowed down over the last couple of years as the consumption side of the economy has been weak. But whether it's China plus one or renaissance of manufacturing, which I spoke about earlier, that is certainly a theme. Energy transition is a big theme. In fact, in India, that theme is also being aided by the fact that we have a huge cyclical upswing in the power sector because power demand is now outpacing the supply. So I think that is a theme. There is Make in India is a big theme across sectors, including defense. So all these themes are certainly being played out there. I think one thing we are now incrementally getting more optimistic on is the revival on the consumption side of the economy. I think that part of the economy has lagged for the past few years. I think cyclically it's due for the recovery. You would have seen in the budget there is some degree of impetus that's been given from the central government. More importantly, if you see many of the state government budgets, they are now actually directing more subsidies and allowances, which actually will aid consumption as well. We are already seeing some green shoots in recovery on the rural side. So I think that is one trend we think will also come back to the mainstream in the coming quarters.
Right. So, talking about these mega trends, I was coming to sectors and themes only now, next, after discussing the globalization. So, in your answer, you've mentioned about defense, power, consumption. So, you seem to be bullish on these sectors and themes. But if we talk about valuations also, what are some of the sectors which are overvalued and then some sectors which still have some steam? Maybe start with the good ones now. Are these the good ones? Defense, power, consumption?
Yeah, so as I said, some of these themes have already been at play. You cannot call them undiscovered themes. So valuation do reflect that. In fact, if I look across the market is trading about one standard deviation higher than historic average on a PE basis. There are only three sectors: consumer discretionary, utilities, and financials, which are actually trading less than one standard deviation over the historic mean. Financials is one sector, banks in particular, which are trading at a discount to their historic trading multiple, right? But having said that, I don't think we can really broad brush that as an investment thesis just because the sector valuations are cheap or expensive. As I mentioned earlier, our focus is more where we have visibility for long-term earnings growth and outlook for long-term growth is there. And there are power sector names we are still very positive on. There are defense names where we are very positive on. But equally, there are names in defense that we have sold over the last 2 months as stocks related. So I believe once undervaluation is really out of the equation now in the markets, the focus will be not so much as top down on thematic investing, but really micro investing. I think many macro events, including elections, budget, is behind us. And focus will now shift to micro investing, which is looking at the companies and their earnings and who's able to deliver and who's not.
Right. So you mentioned about banking and financials also here. I want to specifically dig a little deeper here because, as I said, the first time I saw one of your interviews was during the time of DHFL, ILNFL's crisis, right? So at that point, the market seemed really crazy. What are you feeling about the Indian banking system right now, especially when we talk about NBFCs?
So I think overall the banking system and actually more broadly the financial system is in very good health. Uh, um, um, if you look at issues that what the challenges to the sector in the past decade, whether it's related to asset quality, those are not there at all. We have seen some increase in NPAs, but it is just from a very low point. Overall NPA levels, net NPA levels for the sector are still under 1%. The other challenge that came through for NBFCs in particular during that period was on account of asset liability mismanagement, and some of them had poor capital adequacy. I think that is also not there. So most of the NBFCs have leverage level less than 5 times. Regulations have been tightened a lot. So most of the NBFCs have, actually all NBFCs don't have any ALM mismatch. They also have liquidity coverage ratios similar to what banks have now. So I think the system is very, very stable. The balance sheet is very healthy. Having said that, one of the reasons why the sector multiples are also low is growth is not as strong as what we saw historically. right? And there is a challenge in terms of growth relative to the historic growth rates. Growth is also more democratized. So earlier, there were a few entities which had better asset quality, better capital, and they used to grow at 25-30%, and large part of the system used to grow in single digits, right? Today, roughly all banks, whether public, private, are growing somewhere between 12 to 15%. NBFCs are growing at 15 to 20%. So the growth rate has kind of gravitated to mid-teens for everyone. And that is reflected in the fact that valuations have also moderated.
All right. So, in the recent earnings seasons, some banks and lenders have gone easy on retail lending, but there can be seen like some early signs of stress when we look at unsecured lending. So, does that worry you? Are these signs that worry you? Because the RBI seems to be worried.
I think one of the reasons it's not so much of a worry is that RBI acted on it proactively, right? So compared to the last time around when a lot of tightening happened after the NPS cycle was visible, if you recall, RBI increased the risk weights on unsecured loans. I think it was 2 or 3 quarters ago. It pushed banks and NBFC to lower their growth rate in the unsecured segment last year itself. So I think we believe because the regulator has been so proactive, it is not really something that will kind of become a major issue. If you see overall size of the unsecured book for the entire industry, it is a low single digit percentage. The stress is primarily confined to really small ticket personal loans, which is barely 3% of the retail loan piece overall in the industry. So I don't think it is a size, the exposure is a size that it will cause any systemic challenges or challenges for any bank in particular. Of course, it will be a headwind compared to the kind of low provision that banks had to make last couple of years. So there is an increase from that level. But is it at a level where banks' capital will start getting impacted? The answer is no.
All right, all right. So, if we look at again the overall picture, the big picture, what are some of the surprises, both positive and negative, that you are thinking the most about and probably also positioning your portfolio for?
Sure. So I think one of the things that we are looking out for is on a market-wide basis is also the whole supply of paper. Right, so we spoke about demand coming from mutual fund and FIIs. Another trend we have seen build out over the last 4 quarters is the selling, and we have seen selling from private equity. We are seeing selling from promoters, including multinational parents, in magnitudes that we haven't seen before. Right. So I think this is something we need to be wary of. In fact, we tried to estimate what's or that. So in the last 15 months, promoters have sold nearly 180,000 crores of stock, right? And in addition, there have been IPOs of close to 1 lakh crores. And if I see the IPO pipeline over the next quarter, July to September quarter, the visible or announced IPO pipeline is 3 times the IPO pipeline that was in the June quarter, right? So I think that is something that we need to be mindful of, that because valuations have moved up, like in any market, if demand and price moves up, supply also increases. So we are seeing a very strong supply response as well. And that is something that can cap valuation. So people should not expect just because mutual fund SIPs continue to grow and insurance flows continue to come in the market, it will just mean that market multiples also continue to expand because supply is going up as well.
Right. So again, when we talk about these flows, the selling in the market, we talk about IPOs, we talk about stake sales which are flooding the market. These normally happen at the peak of a market cycle, right? And again, as you pointed it out, is not considered very negative, is not considered very positive, is rather considered negative, right? So why is this rush to sell there in the market currently?
No, I think it is just a reflection of the valuation. So, for example, if you look at MNCs which are selling their stakes or IPOing their Indian subsidiaries, the Indian businesses being valued at P's which are 4 times the P the parent is trading at. So if the parent in Europe is trading at 20 times earnings, the Indian business is being valued at 80 times earnings, right? Or if this auto company is trading in its home market at 6 times earning, it can list its Indian business and take out some cash at 25 times earnings. So, from a capital management point of view, clearly this seems advantageous to them. It is similar to what happens when market multiples are low. That time, companies and promoters look to buy back their stock. So, this is really the inverse of it.
Right, right. So more often than not, the buyers on the other end of this huge offloading are majorly the domestic mutual funds or the retail investors. So are they getting the bad end of this deal here?
So I think it's a free market. As I said, conversely, you may look at it that if so much buying was there and if these sellers were not there, then buyers would have had to pay even a higher premium for it. Right. So I think everyone is an adult in the market. So people are taking that risk very knowingly, and only time will tell who got a good deal.
But surely this is a trend which is worrying, right? It's a red flag in the market right now?
Yes, and I think it also should give us a cue that just because there are certain inflows into the market, right? Just because there is some money from insurance and pension and mutual fund which will continue to come into the market does not mean that market will only go up, because there will sellers will also respond.
Okay, okay. All right. So moving on to one of the recent announcements that was made in the budget, and the markets reacted to it very instantly, right? So there have been different views as to what the increase of LTCG on a post-tax basis would do for foreign investors. Will that make the Indian markets, the Indian stock markets, less attractive for them? Like, what is your view on this?
I think the answer simply is yes, and both the increase in STCG and LTCG will change the relative return expectation for the investors. I think for domestic investors, probably the asset allocation does not change as much because there is still a large gap between the rate on capital gains and the marginal tax rate. But for foreign investors, it does certainly bring down the relative attractiveness in India. But that is something that the government seems fine with. The fact is that even in the years 2020, 2021, when foreign investors actually sold a significant part of their holding in India. And as I said, that was not to do with what was happening in India, what was happening with rates globally. The markets did well. There was enough domestic pool of capital. So I think these decisions have been taken with the cognizance that domestic pools of capital are now large and sufficient. And therefore, even if there is kind of moderation in foreign flows, the markets can hold their own.
Since we are discussing the budget here, I'm going to ask you a hypothetical question right now. If you were the finance minister, what would you have done differently in this budget?
So I think one thing is that any change into in taxation, and particularly on the long term side, has to be done with grandfathering, right? Because people who invested 2 years ago expecting a 10% rate, right? For them also, there is a change. And if you go back to 2018, when the capital gain LTCG came in at 10%, investments prior to Jan 23 were grandfathered, right? Sorry, Jan 2018 were grandfathered. So I think one thing clearly that should have been done is even as we go for a higher capital gains regime, to really remove any distortions between various asset classes, you have to grandfather the historic investments, or at least the historic part of gains on investments. The second thing, I think, where the government has potentially missed a trick is pushing divestment more. So while we spoke about the fact that promoters are selling large amount of equity stakes, private equity is selling. Uh, One of the largest holders of equity in India, and those who have seen probably the maximum rise in their multiples is Government of India, right? So if you see the re-rating PSUs have had, it's in the last 3 years, and despite that, we have not seen a step up in sale of stakes by the government. Many public sector enterprises do not even meet the minimum public shareholding norm of 25%. So I think this kind of market environment would have been useful both in terms of trying to meet that threshold, as well as for the government to raise its non-tax revenues.
Okay, all right. Also, if we talk about narratives versus reality, because that's been a topic of discussion and a cause to discuss time and again, the sentiments are the big factor that drives the market, right? But the reality may not actually match the sentiments of the investors. So, because of this mismatch, what are the major stories, if I have to put, right, that are driving the markets, which might seem true and which might seem false?
So I think this mismatch happens only in the short term, right? Again, short term maybe 3 months, it may be 3 years. So we don't know, but I think reality eventually always catches up, right? And I think for me, one of the things to really focus on is earnings, right? So I think earnings is the reality. While we may have expectation that earnings growth in India will continue to be at 20%, if the fact is that earnings come at 10%, the market will respond to it. Right. So I think that is something that all investors should focus on. That what is the pace of earnings that is coming in, and I think today, I think the other narrative around public sector entities improving their performance, I think those are fairly real. I think there's across the board, maybe I'm generalizing it too much, but across the board there has been an improvement in performance and governance at public sector enterprises. Cyclical factors are definitely playing out, whether you see on the investment side. In fact, last 4 years it was just government capex that were driving it. We are seeing clear signs of private capex pickup, just on the basis of announced plans of the listed companies. If you see the real estate sector, the demand for real estate continues to be strong and is now translating into increased construction activity. So I think those are playing out. I think one area on narratives that we need to watch out for is potentially China plus one, because I think China's manufacturing capacity and investment continues to grow. So, and despite all the curbs that have been put by US and Europe on trade with China and tariffs, China export growth continues to be very positive, right? And some of that has just been redirected rather than direct exports to the US. It's going through Vietnam, Mexico, or to the US, and China has also found new products and new markets. So I think replacing China will not be so easy. So I think one has to be quite careful when we kind of analyze the impact of China.
So when we talk about China plus one, one, replacing China won't be that easy. Two, is Vietnam not a really big competitor when we talk about China plus one?
It is, but again, it really depends on the product you are really referring to. So if you look at electronics, if you look at some apparel manufacturing, etc., Vietnam is a big competitor. But if you look at some of the other products, for example, on the chemical side, Vietnam is not a big one. So it is a bit more of a nuance conversation which products you are looking at. And in some cases, it's Vietnam, in some cases, Bangladesh. If you look at autos, it is actually even Mexico. So there are various other markets, all are competing along with China.
Right, right. So when we talk about narratives versus reality, what happens with investor behavior when we talk about the narratives and the huge market sentiments is they majorly just go with the flow of what the bigger sentiments of the markets are, right? So as a vantage point of being as the CIO, what are some of the aspects of the investor behavior that concern you at this point?
So I think, see, if you look at most of the companies where the valuation multiples are expanding, right? So maybe that is a signal you can use that there's a narrative driving investors into that, right? Uh, then you can have a simple reality check: is earnings growth backing it or not? Right. So if you have this mismatch that earnings are getting cut, and in fact we saw it in IT sector results this quarter that after the IT sector results this quarter, the stocks rallied, but actually earnings estimate were downgraded. Right. So I think that's where you can easily see the mismatch coming through, that there isn't a big turnaround in the sector visible yet, but there is some rotation that is happening into the sector, and you try to avoid that.
So there's a speculative mania that exists in the market currently.
Yeah, so you can say it's speculative. It is sector rotation. People kind of go back to pockets of the market which have underperformed in quest for value. So there can be various reasons that can drive that behavior.
So since you said some part of it can also be the speculative mania, how worried about are you when you look at the speculative mania happening in the markets currently?
So I think if I look at the cash market, I think and historically, uh, the biggest catalyst for speculative activity to blow out, or catalyst for it to end, has been leverage, right? So if there has been too much leverage in the market, people taking loans against shares and investing, so that has been very visible historically whenever any cycle has ended. This time around, at least to us, we don't find any major pockets of leverage. Even in IPOs, historically, a lot of oversubscription used to be driven by IPO financing, but this time around, RBI has kept a very tight lid on IPO financing as well. So yes, there is frenzy in many IPOs and they get oversubscribed 70, 80, 100 times because returns on IPOs have been good. But at least I don't find as much leverage even on the retail side. The frenzy that I see is speculative element that I see is more on the F&O side, particularly on index options. So I think there have been uh, very large activity since COVID that has gone on in the index option side. You would have seen statements from the regulator that they are looking at measures to curb it. Because this activity primarily happened just on the expiry day and the last few hours of expiry. So that's the speculative piece that I think is at this point of time very large and potentially you'll see some regulatory action on.
Right. So, since you have discussed about how well the markets are doing, what are some of the green flags and the red flags for someone to look at, how well the economy is doing, some of the regulatory concerns as well. If we look at some of the investing advices we need to give someone, for someone who is just dipping their toes in the Indian market, what are some of the key moves or strategies to build a strong portfolio that you would suggest?
So I think one simply is that please have a long-term orientation when you're investing in the market. Do look at diversification. Just because one asset class has given very high return in the last 1 year or 3 years is no guarantee it will do so. And this I mean both from the fact that how much you invest in equity to debt, but also within equity, how much you allocate to large cap, mid cap, small cap, right? So if you ask anyone who has invested in the last 2 years, small caps is probably the only place to invest in, right? But as a long-term investor, you need to kind of allocate it over the diversified basket. Um, and the third is guard against complacency, right? Because market will have cycles. I think even as we say that this year or next 2 years, market returns will be in line with earnings growth, say 10 to 15% each year. It does not mean that each year it will give you that return, right? It might be -5 this year and +20 next year, or plus 15 this year and -5 next year, right? So I think when we are talking about this compounded annual growth rate, it's over a long period of time. Year on year, it will not give you a steady return.
Right. And also, when we talk about investing from a perspective of different generations and different age streams, right? People think that how Gen Zs invest or how they think about money is startlingly different from how, let's say, the generations before thought about it. But there was also a recent Bloomberg article which said that Gen Zs are actually saving more than what other generations did at that age. So, are you seeing any trends of how the coming generation, the ones who are just starting to work, looking at investing money, or how, according to you, they should be looking at? Because they get excited with things that don't require patience. They do not want to play in with patience. They want to play with the instruments that seem risky. So, how have you seen in your capacity that taking place?
Actually, yeah, I'm not seeing that. In fact, we are actually seeing that a lot of young investors, a lot of Gen Z investors are investing in mutual funds. They are investing in diversified mutual funds, and a lot of them are doing SIPs. Right, so it's not just that they are here to make a quick return. They invest in a small cap fund and take it out after 2 months. So actually, for me, one of the standout has been that how many people who are in their first year of job start an SIP, and they are actually doing an asset allocation decision. They are not really making investment decision. And this is very, very different from the earlier generation, where equity allocation always used to be an investment decision at a point of time because the market is looking good for this year or the next year, people will do a lump sum investment. So I think that behavior is certainly very different.
Right, right. Also, on a personal note, what's your own investment philosophy? What are some of the golden nuggets of wisdom that you've picked over these years that have helped you build the approach that you follow now?
So I think it's maybe I'm repeating myself again. Is like always think long term because found that predicting short term is nearly impossible. At least for me, is nearly impossible. But equally, if you try to forecast the medium to the long term, whether it's a company's prospects or the market outlook for the next 3, 5, 7 years, one can have lot more confidence and degree of success in doing that. But if you want to kind of predict what the market will be like in 1 month's time, or what will the next quarter's earnings will be, whether it will disappoint the market or surprise it positively, I think it's your odds are as high as a toss of a coin. So I think do focus on the long term, and I think more likely than not you will make the right decision.
Right, right. All right. Thank you so much for sharing that with us. And again, thank you so much for being at the big picture and talking about everything ranging from markets, different sectors and themes that are interesting to you right now, talking about the valuation concerns, talking about economy, and even giving some of your golden nuggets, gyan and wisdom to everyone who will be listening to this. And again, once again, thank you so much for being on the big picture, which is presented by Markets by Sirotha.
Okay, thank you, Bob.
And well, that is all for today's episode. I hope you're able to take away some insights from this interesting conversation that makes you feel a bit more smart. And stay tuned for more such insightful big picture perspectives every week.